Good evening, students. Welcome back to the chapter 5 of corporate finance, that is net present value and other investment rules. Here we will see the capital budgeting decision related discussion, how the capital budgeting is being done because a lot of investment is involved. So, what are the process? How we go ahead? How we make the thumbs up for making the investment? All these things we'll discuss here. The different capital budgeting techniques we will discuss. So, we'll see the payback period, discounted payback period, and the advantages, disadvantages. Similarly, we'll see the net profitability index, net present value, internal rate of return, modified internal rate of return. We will check in different kind of scenarios how we do the net present value, internal rate of return, and related discussions we will do in this chapter. The outline will be in the first section we will see why net present value is very important. In the second section we'll talk about the payback period, which we call it as PBP, and the disadvantages of payback period to be addressed in the discounted payback period or discounted PBP. In the fourth section we'll see internal rate of return or IRR. Then we'll see the problems associated with IRR approach. And the last we'll see the profitability index method. After that we'll see the practice of capital budget. Why net present value or NPV method is more appropriate and more popular? The answer is NPV uses the cash flow. NPV method never uses the accounting profit. It uses the cash flow. How the cash flow is calculated? With the accounting profit, when we add back the depreciation, because we are not paying anything to anyone on the head of depreciation, but the accounting profit deducts the depreciation. So in the NPV, before calculating the NPV method, we add back the depreciation with the net income, or accounting profit is added with depreciation because you are not paying anyone, add back. And we also make the adjustments for working capital changes. Because the accounting profit is added with depreciation and adjusted with the working capital changes, it is the most appropriate method. And NPV uses all the cash flows of the project. It's not like few of the cash flows are ignored at any part of the project. If you are using NPV, you are using from the very beginning to the end, throughout the life of the project, all the cash flows are being considered. NPV discounts the cash flow properly. To calculate the net present value, what we do? We first of all project the cash flows, cash flow 0, cash flow year 1, year 2, year 3. Throughout the life of the project, we project the cash flows. Once we project our cash flows, then we take a required rate of return. Then we discount those cash flows of different projected years to today's value or present value. So all the future cash flows are discounted to the present value. Therefore, it is very scientific. Time value of money is taken into account. For example, you are getting 10,000 after 1 year, 15,000 after 2 years, 20,000 after 3 years. If your cost of capital is 10%, then the present value of 10,000 after 1 year is 10,000 divided by 1.10 to the power 1. The cash flow you receive after 2 years is 15,000. The present value today will be 15,000 divided by 1.10 to the power 2. You get after 3 years 20,000. The present value today will be 20,000 divided by 1.10 to the power 3. So in the net present value, we take the present value of all the future cash flows. Or in other words, we can say the net present value discounts the cash flows properly. So time value of money is properly taken into account. Let us see the rule. Net present value is equal to the total present value of future cash flows plus the initial investment. So total present value of future cash flows plus initial investments. So as we have discussed in the previous example, after 1 year 10,000, after 2 year 15,000, after 3 year 20,000. And for this project, initial cash outflow is, for example, 15,000. Then what you will do to get the net present value, the cash flow you are getting after 1 year, after 2 year, after 3 year, you calculate the present value. I explained you how to calculate. 10,000 divided by 1.10 plus 15,000 divided by 1.10 to the power square plus 20,000 divided by 1.10 to the power 3. This will be the present value of future cash flows. Plus initial investment you have to make 15,000. So minus 15,000 will be the initial investment. That will give you the net present value. So for that, what are the steps involved? As I told you right now, first you estimated the future cash flows. That is, in our previous example, future cash inflows will be 10,000 after 1 year, 15,000 after 2 year, 20,000 after 3 year. That is the future cash flows. First estimate the future cash flows. How much and when? 10,000. How much? 10,000. When? After 1 year. 15,000. How much? 15,000. When? After 2 years. How much? 20,000. When? After 3 years. First step is calculate the or estimate the future cash flows. We have done that. How much we have calculated and when we have estimated. Estimate the discount rate. What is your cost of capital? In the previous example, we have taken 10% is the cost of capital. Number 3, estimate initial cost. We have taken in the previous example, initial cost is 15,000 minus. You have to spend 15,000 to procure this project. So initial investment is cash outflow minus 15,000. Outflow means minus, so minus 15,000. So these are the 3 steps you have to do. Number 1, future cash flows, how much and when. Number 2, discount it. For that, you need a discount rate, 10%. Number 3, estimate initial cost, minus 15,000. Then you talk about minimum acceptance criteria. When to accept, when to reject. Acceptance criteria. What is the acceptance criteria? Normal minimum acceptance criteria is you accept the project if NPV is positive, greater than 0. You reject the project if NPV is negative or less than 0. Ranking criteria. If you have multiple projects, then you will rank 1, 2, 3, which one will be first priority, then second, like that. The project with highest NPV will be ranked first, and you have to follow accordingly. The lesser than that will be 2, lesser than that will be 3. So ranking criteria is the highest NPV will be ranked first or first preference. Calculating NPV with a spreadsheet. So in the spreadsheet we have NPV function. Straight you can calculate with the function called NPV. First of the requirement is required rate of return entered as percentage, not decimal. Percentage we enter. It is not percentage. So the first component entered as required rate of return entered as a percentage. We will see. So the cost of capital, here in the previous example we have taken 10%. So it is entered into the spreadsheet as a percentage. Next is second component is the range of cash flows beginning with year 1. 1, 2, 3. Here we have taken cash flows 10,000 after 1 year, 15,000 after 2 year, 20,000 after 3 year. So those cash flows are to be entered second component. add the initial investment after computing the NPV. How we do that? Let us do it in the spreadsheet. For example, there is a spreadsheet here. For example, here is the year 0. How much? Year 0 is, we have taken in our example, 15,000 is our initial cash flow, right? So minus 15,000 will be our initial cash flow. And after 1 year, how much you are getting? 15,000. Sorry, 10,000. After 2 years, how much you are getting? 15,000. After 3 years, how much you are getting? 20,000. This is the whole life of the project, and cost of capital is how much? 12%. Now go to the theory. First work is enter the percentage as cost of capital. Then range of cash flow from year 1, 10,000, 15,000, 20,000. Then use the NPV formula. Use the NPV formula. How? It is equal to NPV. There is a direct formula called NPV. Use it. First enter that. The first requirement is enter the cost of capital, that is 12%. Next one is cash flows from year 1 or projected cash flows. Year 1, 2, 3 in this example. Once you finish that, you add with the initial investment, that is minus 15,000. You get the 20,122 is the NPV of the project. Alright, let us take another example. Here is the another example given here. Initial investment is minus 30,000. You get the cash inflows from year 1 to 5. The life of the project is 5 years. So year 1 8,000, year 2 10,000, year 3 11,000, fourth year 17,000, and fifth year 12,000. Cost of capital is 12%. What is the net present value? Now, before going for the net present value, I will again tell you how to do it. We have NPV formula. Use the NPV. First enter the cost of capital, comma, the cash flows, projected cash flows from year 1, not the initial cash flow. So let us do it. Is equal to NPV. Go to the NPV and asking the rate of return or cost of capital or discount factor, 12%. Now you have to enter the range of cash inflows or projected cash flows from year 1, that is from year 1 to year 5, bracket close. Now you got the present values of cash inflows or projected cash flows are being discounted. That will be adjusted with whatever you have invested in the beginning, 10,557. So this is the way we calculate the net present value. I hope this is clear, and now let me stop the recording, take your questions.